Welcome, everyone. I hope you can hear me. It is my pleasure to welcome you to the second luncheon we were doing here with Bruce Campbell. And unfortunately, my USB camera is not working, so you're just going to hear my voice. My name is Neil Locke. Thank you for joining us. We have a great agenda scheduled for today. Bruce Campbell is going to kick it off, followed by Quip, Plant Fuel, and Levity Labs. And we're just going to jump into the presentations. Bruce is ready. Bruce, the stage is all yours.
Perfect. Thanks, Neil. Welcome, everyone. Hopefully you're enjoying lunch. What I want to do today was just walk through a presentation here, talk a little bit about what we do here at StoneCastle, how we manage money. I have some slides in the back that we actually prepared last week for the presentation. And we've seen a fair number of significant changes just go on internally in the market in the last week. So I'll reference those slides, but I'll probably show you some of the changes that we've actually seen and why that is important and what effects that's having on our portfolio. So just by way of summary, to give everyone who isn't familiar with StoneCastle just a history of what we do and what we manage. We manage 4 different funds. We manage 2 portfolios for Purpose Investments out of Toronto, the Purpose Canadian Equity Growth and the Purpose Canadian Income Growth Fund. Both those are mutual funds that are available throughout the FundServe platform, both online brokers, full service brokers, financial planners. And then we manage the StoneCastle Cannabis Growth Fund for Spartan Investments out of Toronto. And that's a market that's been beaten up pretty hard this year, but there's tremendous value there. So it's kind of an interesting one. And then we manage our own fund, which is the StoneCastle Fund, which is a growth portfolio as well. So what do the numbers look like as far as our growth portfolios? They're both fairly similar, the StoneCastle Fund and the Purpose Canadian Equity Growth Fund. You can see the numbers here on the top, and then you can see the income portfolio here on the bottom. We've got very strong long-term numbers for both portfolios. When you compare them to the TSX Total Return Index, we've done quite well with the growth fund outperforming, and then with the income fund, obviously our mandate is to generate income, which we do. We pay out a regular monthly distribution with that portfolio, and then we grow the capital as well over time. So we talk about our process at StoneCastle being definable, repeatable, and predictable. So definable in that we have certain criteria for that really define what it is that we do with our portfolio, why we're on offense, neutral, or defense at any given time with the portfolio, why we have positions come into the portfolio and go out of the portfolio. Repeatable in that we could take the data today, 5 years ago, or 5 years in the future, and we would end up with similar portfolios as far as what the attributes of those portfolios look like. So we can never control the markets. Human emotion obviously takes over. But what we can control is the attributes of the portfolio. We know if we have those attributes that outperform over time, then we'll have solid returns throughout the entire market cycle. It doesn't mean we outperform every single year, but we will outperform over the full market cycle. And the predictable part is we'd love to be able to generate predictable returns. That's not possible, obviously, with the human motion of fact in the markets, but what we can do is generate predictable attributes to our portfolio, which is what helps us to outperform over time. If we look at how we position our portfolio from a top-down perspective, we look at a number of different tools here, both from an economic standpoint and then from a market technical standpoint. And we're trying to figure out at any given time whether or not we're on offense, neutral, or defense. If you ask most investors, they probably don't know, or they take their cue on what the market's doing that day. We look a lot deeper than that. So we're looking at economic criteria and then also market technical criteria. When we're fully invested, that's when we're in offense, and we're obviously positioning our portfolio to make optimal returns. When we're in neutral, quite often we'll have a cash buffer, and perhaps we have different securities in the portfolio, maybe ones that are more geared towards income or capital preservation. And then when we move to defense, that's a whole different scenario whereby we're looking to maximize any loss or maximize any defense, and we want to obviously help to buffer the portfolio in any downside. And then the second thing we want to do when we're on defense is to have that cash ready, because we know that, following defense, we're going to go to neutral or offense or both, perhaps on neutral first and then offense. And we want to have that cash available to take advantage of bargains that result as a function of a sell-off in the market. So what do we do and how do we look at that? Well, we're looking to figure out whether or not a recession is imminent. We know recessions typically are bull market killers, and that's where the bear markets typically start. You can see a correction that happens, sort of intra cycle, but typically the big bear markets are the ones that really take the return out of the market and generate those negative returns for most investors. How do we know if a recession is imminent? We look at a number of different factors. There's some of the ones that we look at here on this slide. If you want to join us on a monthly basis, we actually run through all of these in detail. We do a monthly webinar. If you go to our website, to StoneCastleFunds.ca, usually there's right on the top front page, there's a registration for that monthly webinar where we talk about, we'll break down and walk through, kind of all of the economic and also market technical indicators. In addition to the economic indicators, we look at a number of different market technical indicators. So we're looking at the strength of the overall market and what we see under the surface. And that helps us to define, again, whether or not we're on offense, neutral, or defense. The next step that we look at is we look at sector leadership. And so we want to know which sectors are the strongest. And we really do this in two ways. The first is that we look at specifically top down. We look at both relative and absolute, which sectors are performing, so where the money flow is going, and where the return potential is in the future. And so we effectively rank each sector of the market. We know the strength, we know if it's increasing, we know if it's decreasing, and where the money flow is coming, both on an absolute and a relative basis. And then from a bottom-up perspective, we typically see that in the screens that we do, and we know exactly which sectors are really performing. From a bottom-up perspective, once we've figured out whether or not we're on offense, neutral, or defense, we know which sectors we want to be in. Then we're looking at individual securities, and what we're looking for is companies that have some sort of catalyst in their business that's going to accelerate their earnings profile either immediately or in the near future. And why we want that accelerated earnings growth is because we know that there's two ways then for us to make return on that stock. The first is as the earnings profile and the stock price will follow each other. The second is that typically we're identifying opportunities ahead of the market. And so the market, once it recognizes that growth rate, more and more investors get in and they pay a higher and higher multiple for that stock. So we'll see multiple appreciation, multiple expansion. And so that allows our stock price to appreciate on that perspective as well. With our income portfolios, we're obviously looking for a few extra things. We're looking for a lower than market beta. So that's not with every single position, but generally we like to have our portfolio with a slightly lower beta than the overall market. And what we know is that in the income sector, that's something that helps us outperform both on the upside, but more specifically on the downside. And then we also want to look for yield and income growth in that portfolio. So companies that have been increasing their dividend and increasing their yield payout that they have. In addition, we look at valuation of the company to make sure that it makes sense from a relative perspective, and then versus its peers and growth rate as well. Well, how do we do this? We basically rank our universe every day from 1 to 1,000, and we know based on the attributes of the portfolio, both from a fundamental standpoint, but from a technical standpoint, what exactly is happening with each of those individual positions, if they're moving up or they're moving down. We know that a stock that starts off in the number one position will continue to drop. It's just a function of how long it can stay in the number one spot. As it drops down our list, it eventually gets to a spot where we know that we'd be better off in something that's higher on the list. And so we'll sell it, and then we'll go back to the top of the list to review and see what exactly is there. We'll also look at stocks and drill down a little bit deeper to see, what it is that's moving the stock. Is it, earnings change? Is it the market looking out for future earnings? And so we're able to rank and sort our portfolio on any given day, and also our universe, to see exactly where things lay out. Now, obviously, buying is important. Selling is we think equally as important. If you've never read the book, The Art of Execution, it's one that I think is excellent to understand what kind of investor you are and what kind of seller you are. But when we look at selling, we look at a number of different factors. So we will sell the stock based on its fundamental ranking and dropping down to replace it with something that's growing at a faster rate. We'll look at it from a technical standpoint as well. So there's specific technical attributes that we need the stock to have. Once it loses those, we're looking to replace it. And then the last thing that we do is we use stop losses. So once a stock breaks down through a stop loss level, it kind of goes on notice for us. And so then we're reevaluating it based on its technicals, its fundamentals, and what we understand the company to have as far as catalysts. And we'll make the decision at some point in time just to sell it based on the breakdown of that stop loss. So this is what we think helps to differentiate us. Really, we're looking for those high growth companies. And in the last decade, there's been a real narrowing out in the Canadian market. There's not as many investors who are doing the same things as we are. So we're able to come across some of the high growth stories later on in the luncheon here. We're going to have a couple of those companies that we own in our portfolio present, just to give you a flavor of kind of the high growth opportunities that we see. And we really think that this is an area that has less competition than most, and this is what's allowed us to outperform over a full market cycle if you look at our growth fund. As far as where we're at with the market right now, as I mentioned, we've seen a fairly significant change in the behavior of the market just in the last sort of week to 10 days. We put these slides together last week, and since that time, we've seen fairly significant changes under the surface of the market. A lot of it has to do with the concern over the newest variant of COVID, but also what's happening with the Fed. Now, where are we at? What we do is we have an asset leadership model, and we're ranking these 5 different asset classes. So domestic equities, commodities, cash, foreign equities, and fixed income. And what we want to see is domestic equities. Ideally, we'd see foreign equities right at the top. We'd see cash and fixed income at the bottom. Those are the scenarios that drive the best returns for equity investors over time. What are we seeing right now? We're seeing those domestic equities in number 1 spot, but we're interestingly, and commodities is number 2. But what interesting we're seeing is starting to see that cash rise up. So, that's a function of the market becoming, more defensive and becoming more challenging, where cash is starting to look as an attractive investment quality over what we're seeing in other areas. If we look at sort of the long terms, take a step back, looking at equity versus fixed income, these bars here represent when the equity market is outperforming the fixed income market. You can see that these are monthly bars, and it's been going on for some time now. We did peak and saw kind of maximum outperformance, and that started to deteriorate. So this is something we have an eye on. Obviously, when we see the relationship change from positive to negative in favor of equities, but then favoring fixed income, those tend to be tougher times for the equity market. The growth areas of the market don't tend to outperform. It tends to be more conservative. Consumer staples, utilities, maybe some financials, and mostly larger cap. And so we always keep our eye on these trends to see where things are at with that. If we look at domestic versus foreign equities, we can see here that domestic equities right now continue to be the strongest. We have seen a fair sell-off in the foreign equities in the last few weeks, and they're starting to lose some relative strength. This is, again, something that has us on alert. Typically, when we've seen this in the past, it's been a sign that the overall market is changing its characteristics. So it's a little early at this point in time to draw that conclusion completely, but we certainly are on notice with that. If we look at the equity leadership of markets, we can see right now that Canada's up in the number 1 spot. and you know, a lot of the commodity countries have done quite well. This is not surprising, kind of given what we saw with oil, the move that we've seen there, which transpires into stronger financials for the banks as well. And so, you know, those are two pretty heavy sectors in the TSX. And so it's not surprising that we've seen, you know, outperformance in those areas. If we look at the TSX composite itself, we have seen, you know, we started to see things really reaccelerate here in early November after a kind of a period of sideways where we started to see, you know, more breadth and breadth expanding. That being said, just in the last week, with this new variant, we've started to see investors change their behavior in certain ways. And so, you know, again, we're kind of watching this closely to see exactly what transpires, whether or not we're going to get, you know, full risk off move, or if this is just, you know, a little bit of removing some of that sentiment extreme that we saw at the beginning of November. As far as portfolios and weightings go, you know, why we think that the TSX could have a period where it outperforms over a number of years is, you know, really looking at the makeup of those portfolios or those indexes. And we look here, this is looking, the blue bar is the TSX, the other bar is the S&P 500. And you can see that, you know, financials are a big weighting in both, but certainly a bigger weighting in the TSX. You can see materials are bigger and energy is bigger. Obviously in the US, the technology is a fairly substantial size. And then you have, you know, just consumer discretionary and telecom, which tend to be bigger weightings in the index than they are here in Canada. But if we start, you know, if we continue to see energy materials outperform, obviously then our banks perform well. And then at that point in time, we can see, you know, strong performance from Canada. Looking at, you know, the commodity cycle, this is going back over, you know, a long period of time. This is going back to the late 90s here, when the ratio of the market to commodities bottomed. During this period of time, we saw strong outperformance by the TSX. We've seen underperformance to the TSX over the last, call it, decade to the S&P. And now we've seen that ratio bottom out around the same place as it did a decade, or I guess 2 decades ago now. And it's starting to move back up. So could we see another period where the TSX outperforms? Certainly we think that that's a possibility. As far as our risk assessment model we're looking at right now, we're in neutral offense. We've seen this strengthen. If you go back to the summer, we were in neutral. We saw it start to strengthen. It really, you know, got up into the high numbers where we were on full offense, and of late we've started to just see it deteriorate. You know, some of the things that we're watching are the US dollar and interest rates. The US dollar has been stronger, which tends to be risk off move. At the same time, we haven't really seen fixed income appreciate too much. There's obviously been a couple of days, you know, today's a day, Monday was a day, and Friday was a day where we certainly saw the markets changing their behavior. As far as seasonality goes, we know that, you know, November, December, January, February, March, April tend to be fairly good periods of time. There's strong seasonality after the TSX or S&P have had a positive year up until December, that it's, you know, it's very positive going into December. So we think that, you know, there could be some chop here in the next few weeks while the world kind of sorts out what happens from an economic standpoint with this new variant. Once, you know, we get a grasp of kind of how dramatic it's going to be from an economic standpoint, then, you know, at that point in time, markets should settle down and sort of take over from the seasonality standpoint. As I mentioned, we do a monthly webinar each month where we highlight both the top-down indicators, both from an economic and market technical standpoint. And then weekly, we do just a shorter video which highlights some of the changes that we're seeing in some of those. If you're interested in getting on the list of the distribution for those, it's quite simple, just info@StoneCastleFunds.ca, and that will help you to get invited to those webinars as we have them. The monthly webinars are about a 30-minute presentation, and then the the weekly ones are about 5 to 7 minutes in length, and they're all recorded. You can watch them, kind of at whatever time you want. So thanks so much. I'm going to be back later in the program just to talk about a few individual stocks that we like right now. But in the meantime, we're going to hand it over to Neil and the team from Quip.